Well, good morning and welcome. I'm Illinois Extension's Todd Gleason. This is the FarmDoc Daily Live webinar series, Coronavirus and Ag. What is the outlook for the ethanol industry going forward? Scott Irwin and Todd Hubbs, both agricultural economists here on the Urbana-Champaign campus, are with us, along with Eric Moseby. He is the general manager at Lincolnland Agri-Energy in Palestine, Illinois. That's an ethanol production plant. The three of them will take you through the next half hour or so, and then we'll answer some questions from you. If you have those, you can always put them right there in the question box, and we'll get to them when we wrap up the presentation. Let's begin now with Todd Hubbs. He's an agricultural economist and commodity market specialist. Good morning to you, Todd. Thanks for being with us. I think we're going to start, I guess, with this particular poll. Maybe we should take that first. In your local area at the present time, how much are people driving? This is a good poll to get you started with, Todd, I think. So are they about normal? And you may not know because you may not have been out. Slightly below normal, moderately below normal, well below normal. Are the roads? Well, they're just empty. Less than 25%. Go ahead and fill that out. Just offhand, it looks like there's around 270 on you early. We're just in 2 minutes into the webinar here. Usually we pop up quite a bit. I'll let you know what the numbers actually look like. And around 70% of you have voted at this time. So we'll go ahead and close that particular poll out. Here are your answers. Moderately below normal. 36%, say around 80% of regular traffic, somewhere between 25 and 70%, 47%. I think that is the case. Now, Todd Hubbs, I think we can get started with you. Good morning to you. What do you think of the answers to the poll to begin with?
Well, I think that really matches up with what I'm about to talk about, and that's gasoline demand and what we've seen over the last month or two. We saw this tremendous drop-off as the lockdown started going in around the country, where gasoline demand dropped to a little above 5 million barrels a day. But since then, we've seen a pretty rapid recovery, where last week we saw it come up to 7.4 million barrels a day. This is still a far cry from about 9.5 million barrels we normally see this time of year. I think when we see the EIA report come out tomorrow, we might see this go above 8 million barrels a day, as gasoline demand's picking up quite quickly as we start to open up the economies around the country. And that's a good thing for ethanol if we can continue this pace. And we'll talk about a forecast for this later in the presentation. But I think everybody's familiar with this dynamic and how it went about. I think it's just important to get an idea of just how severe it was. So if you could click to the next slide, Jim. And as you can see, as you would expect, ethanol production followed it down. We saw ethanol plants shutter and reduce production, and we got down to 537,000 barrels a day a few weeks ago, and it picked up to 617,000 barrels a day in last week's report. I expect it to go up again this week. But even with this, it's a really sharp reduction in corn demand in general. I think it might be a little bit of a longer process to get ethanol production back up to where we're seeing it at basically 10% or around that for gasoline demand week to week. And one of the reasons is in the next slide. Jim, can you click forward to that? We saw ethanol stocks shoot up quite dramatically even with production ratcheting down. And we're starting to work through them. We're down significantly from where we were at the peak of a little over 27.5 million barrels. Last week, we were down at 24.2. I think we'll see it come down again this week, even with ethanol production ratcheting up a bit. But we're going to have to work through some of those stocks to get down to where we normally are. So with driving sort of pulling back, and then we're starting to see it come back in strength now. And I think that poll reflects, what we've seen with gasoline demand. An uptick, not as bad as it was, is starting to build strength as people get back out there. So I expect on the demand side for gasoline, we should see some support for more ethanol production as we move forward. One of the issues, and this in particular is important, not as important as we think, but ethanol exports through March, and this is where we got the data from EIA and from the Census Bureau, it was slightly above last year's pace. But I would expect, and I think it's fair to say, that we're going to see those numbers drop off dramatically in April and May and probably into the summer before we see a recovery. A lot of our major export markets, particularly Brazil, Canada, India, have been in some form of lockdown, and they're still going through it. And I think this is going to be relatively weak. Hopefully, we'll see it pick up some when we get into summer months, particularly if other economies open back up. I know there's been a lot of talk about China. There's always a lot of talk about China buying ag products and ethanol in particular. They've bought just a sparse amount. And this is an open invitation. If they want to buy a couple 100 million gallons, feel free. But I'm not sure we're going to see that anytime soon. So overall, if you can click the next slide, we've seen corn use for ethanol just crater. In this April projection, you see the bright reds is my projection. It's around 250 million bushels. We got off to a strong start in 2020. We had good ethanol production, good corn use, and this pandemic's just ratcheted it down a lot. I think you'll see April numbers be a real shocker, and it'll start building back in May. So when we think about where ethanol is headed, I think we may have seen the worst of it, barring some kind of rekindling of the pandemic. And I think we're in a build and strengthen mode. I'll turn this over to Scott.
All right, thank you very much, Todd. I'm going to now begin my part of the presentation by stepping back and looking at what has been going on at the ethanol plant level. This is a chart that I've followed for some time, the weekly price of ethanol at Iowa plants with the last observation last Friday. And we can see that as the pandemic developed, that ethanol prices literally fell out of bed to levels that really were unheard of and literally off the chart, dropping down as low as 60 or 70 cents per gallon. We have seen in the last few weeks as we've had that V-shaped recovery in gasoline usage, that's pulled up ethanol prices along with it, at least back up to $1 a gallon. But it's important to recognize that that is still by a wide margin the lowest prices that we've seen since this data series starts in 2007. So we're still in an environment of very low ethanol prices. So what happened is that basically, as the pandemic began, we could see that, well, there was tremendous uncertainty about just exactly how much ethanol demand and gasoline demand would be destroyed through this pandemic. And so the market began sending signals that ethanol plants needed to shut down. And that's exactly what's shown here. We have that same ethanol market price in blue, and the red is a measure of the shutdown price. This is the price when the plants are not covering their variable cost of production. And we can see as we went into March that basically that's exactly the level that the price of ethanol was driven down to, at a level where we needed to shut down production, and roughly half of ethanol production in the U.S. at various points in the last 6 weeks has been shut down. Now, again, with that recovery in ethanol prices back above $1 a bushel, $1 a gallon, we're now well above the shutdown price. So it's not surprising that we're beginning to see press reports of some of those ethanol plants beginning to reopen. And that's exactly the signal that the market is sending. What we have here is something really interesting that happened as the pandemic developed. We saw some really spiky price reactions. The blue line on this chart is the price of corn at Iowa ethanol plants, and we can see that as the pandemic developed, that the price of corn here on dollars per ton really dropped dramatically towards $100 per ton, where At the same time, the price of DDGs skyrocketed to $200 a ton as livestock feeders started bidding up what was obviously going to be a reduced supply of DDGS as these ethanol plants shut down. And if we could go to the next slide. This just simply shows the ratio of DDGS to corn prices at Iowa ethanol plants. And in the midst of that exceptionally spiky price behavior, we saw the price of DDGS driven to almost twice the level of corn prices. I mean, way beyond anything we had seen historically. Price relationships are now returning more back to normal at around 1.4 to 1, but that's still historically very high price for DDGs. And we will probably see that relative strength of DDGs continue until we see more ethanol plants reopen and the supply of DDGS begins to return more to normal. This chart now shows the a measure that I compute for a representative ethanol plant model that I maintain of the net profit for a representative ethanol plant per gallon, net of all variable and fixed costs. And again, the last observation is last Friday. This chart helps us show one of the real difficulties for the ethanol industry going into the pandemic is that the ethanol industry had already been going through one of their worst periods of losses in the last dozen years. In fact, 2019 was, on an annual basis, the largest loss for a representative ethanol plant. According to my records, over $3 million loss in 2019. That was the biggest loss since 2012. And so the pandemic was on top of what was already a very difficult period on average for the ethanol industry. And consistent, notice in the last couple of weeks, we have finally actually driven net profits for ethanol plants back into the positive territory. And it's obviously going to, that'll have to continue to get the rest of the shuttered ethanol production in the US back online in order to keep it online. So I expect, at least for the next few months, we'll likely see positive profits for ethanol plants as they reopen, as the market has to incentivize them to get reopened. Okay, now I want to switch gears a little bit and talk about an issue that in the midst of the pandemic has gotten a lot of attention, which is the competitiveness of ethanol at the pump. In essence, the concern has been with the crash in crude oil and gasoline prices that ethanol was going to potentially lose its competitiveness in the retail gasoline blend, and we might see the start of a period with less than 10% ethanol in our gasoline blends. So I'm going to take a look at that question. The data that I use to look at that is from the US Gulf. We'll see in a few minutes why I use that measurement. Here I'm showing the price of CBOB, which is gasoline blend stock that is used as the petroleum component in US gasoline blends. And that's in the red here. And you can see as the pandemic developed, like everything else, the price of blend stock just collapsed. And at the Gulf, it actually got, I believe, under 50 cents a gallon, just an unheard of low level. And we can see that ethanol prices at the wholesale level at the Gulf never followed down in quite as dramatic pattern. And currently, the ethanol price at the Gulf is well above the price of CBOB, which of course raises concerns about the competitiveness of ethanol in the gasoline blend. Next slide, please. But that is only half of the equation when it comes to the competitiveness of ethanol in the gasoline blend. There's what we call the energy component, which is the comparison that I just showed you. The other part has to do with the octane value of ethanol. It has generally been the cheapest source of octane in gasoline blends for a long time, and that's represented in this chart, which shows the price of something called aromatics. This is these are petroleum products that are high in octane, like ethanol, and the primary competitor to ethanol to add octane to gasoline blends. And as we look at this chart, which goes all the way back to 2012, you can see that ethanol has a distinct price advantage as a source of octane compared to the aromatics. Now, that advantage, as we can see on the chart, has narrowed dramatically during the pandemic. Both ethanol prices and the aromatics prices have dropped, but the aromatics have dropped much more. With the price of aromatics in early April almost being equal to ethanol. So ethanol's advantage as a competitive source of octane has clearly been diminished here in the pandemic. But notice, like lots of other things, that that's probably going to, again, change quickly as we continue to recover gasoline demand. Next slide. So what I do here is I net everything out to provide an overall assessment of the net value of ethanol in the gasoline blend. It's what I call the sum of the octane premium plus the energy penalty for adding ethanol to gasoline blends. On average, that is 66 cents per gallon of ethanol blended. That's the historical average. There's a lot of variation around that. And in the pandemic, you can see in the last couple of months that that has gone negative. A negative value here means that adding ethanol is actually costing drivers. So it's not a very large amount. And that I would note before anyone in ethanol and ag industries panics, we've gone through some long periods, for example, in 2015 and 2016, where that has happened at similar levels to what we're recently seeing. And so something like this, as long as it doesn't persist too long, is not likely to threaten the long run competitiveness of ethanol in the gasoline blend. I do also want to make one additional point. Can we go back to that slide, please? That it is important to understand that I'm not, when I put the figure up of 66% per gallon of ethanol, that's not the amount on average that that drivers are saving due to ethanol. That's 66 cents per gallon of ethanol. And so on a 10% E10 blend of ethanol and petroleum gasoline, you have to divide that by 100. So it's 6.6 cents per gallon savings for drivers in the US. That's still a large amount in aggregate, but just want to make sure that there's no mistaking what that 66 cents means. Next slide, please. So when we take a look at what is fundamentally a really important issue for the ethanol industry and agriculture through corn grind, where are we likely to end up in terms of the competitiveness of ethanol at the retail pump level? very helpful perspective is provided here, which basically this is the aggregate blend rate for ethanol in the U.S. Finished motor gasoline supply. This is monthly, going back to January 2007. And you can see that after 2011, 2012, we've essentially been at 10%. All that means is that virtually every gallon of gasoline in the US sold contains at least 10% ethanol. And in fact, in the last 3 or 4 years, that blend percentage has risen a bit above 10% as we have increased the usage on a small scale of higher blends like E15 and E85. The question we're asking here is, what's this going to look like going forward? We have seen ethanol be less competitive relative to the aromatics in terms of octane content. I expect, though, that that's going to return to a more normal relationship. Plus, we also have to realize that the safety net of the RFS mandates are still in place. And I'll talk a little bit more about those later. But when you put the long run competitiveness of ethanol with the safety net of the RFS mandates together, I just don't see any risk moving forward that we're going to, on average, go below a 10% aggregate blend rate for ethanol in the US. So whatever gasoline usage turns out to be moving forward, I expect it to contain at least 10% ethanol. And I think that's an important point to make as we consider issues like the ethanol grind for corn moving through the remainder of 2020 and into 2021. So with that, go to the next slide. And I'm going to turn it back over to Todd.
Thank you, Scott. So, just building on what Scott was saying about how important gasoline demand is to corn use for ethanol and how much ethanol production will do, what I've got here is the previous slide on weekly gasoline demand and then a forecast for the rest of 2020. And as you see in May, I do expect us to get above 8 million barrels per day in the upcoming report, or very close, and continue to build on that as we move through the remainder of this marketing year for corn, which ends August 31st. And when you get into the next marketing year, September and on, what you're seeing here is basically the kind of level I think is appropriate to hit what USDA forecast for the 2020-21 marketing year, which was 5.2 billion bushels. We'll see what I would consider to be a 4 to 5% drop from normal corn use for ethanol. If you think 5.375 to about 5.425 would be what we would consider normal corn use for ethanol at this point in time, which I do. So I think you're going to continue to see a V-shaped recovery. It could even be more dramatic. When we get into the fall, and I know there's been a lot of negativity about a resurgence of the coronavirus and what that'll do to the economy, that uncertainty is huge, and it'll have big implications for gas demand, ethanol production, and on top of that, more importantly to us here, corn use for ethanol. So can you go to the next slide? So the implications, like currently the USDA has about 4.95 billion bushels of use for this marketing year. That's down significantly from where we were earlier in the year. There's a potential to see between 4.8 and 4.85 billion bushels of use if we see a slightly slower recovery than what we're projecting in the previous slide, which is feasible. I expect exports to be slow as major export destinations deal with the pandemic. So we could see some more bushels come out of that projection before it's all said and done. If gasoline demand does truly pick up, I think the USDA forecast may be close. We look forward to 2021, 5.2 billion bushels. Like I said, about a 4 to 5% below a typical marketing year in my mind. The key issues are, and like I said, the uncertainty regarding what a COVID-19 shock would do this fall. is massive, and we've seen what it does when we start locking down. I'm not sure we would lock down again. The other thing is ethanol production potential after this huge shock. I say here, who makes it out alive? There's been a lot of talk about the ethanol industry going down 15, 20, 25%. That doesn't mean we'll see corn use for ethanol per se drop that much. As Scott mentioned in his profitability slide, there's a lot of what I might consider, and Scott can disagree with me if he wants, there was a lot of excess capacity in ethanol production that can be removed, and we can still be hitting these numbers that USDA's put out. So when you hear people in the ethanol industry, and I think Eric might have a good take on this as well, it doesn't mean we wouldn't hit this 5.2 billion bushels. It means some people are going to be gone, and some of that excess capacity will be removed from the system. The big question, as always these days, is how will policy impact these outcomes? And I think Scott's got something to say about that in the next slide.
Well, there is a lot going on with respect to policy affecting ethanol. The first one policy issue I want to highlight is a decision that came out of the 10th Circuit Appeals Court in late January on EPA policy on small refinery exemptions. Just a little brief background. The EPA under the Trump administration had been issuing large numbers of small refinery exemptions in an ex post manner, and not accounting for these as they would set the standards in annual rulemaking, which had the effect of cutting the annual mandates. So this court decision is a really big deal because it, on its face, severely limits the ability of the EPA to award SREs. And if it is applied nationwide, I would say that the appeals court ruling, if allowed to stand, and the EPA applies it nationwide, it effectively kills the SRE program as it has been administered by the Trump administration EPA. And we see the obligated parties and the price of RIN credits used to demonstrate compliance with the RFS reversing, climbing to much higher levels to reflect this new reality. Now, something really interesting to the ethanol industry is that through all of the political battles over SREs, the final rulemaking for the 2020 standards for the first time accounted in a forward-looking sense for expected SREs for the 2020 calendar year obligations. And again, if the 10th Circuit ruling is applied nationwide, there will be basically almost no SREs eventually awarded for 2020. And so effectively, the way the rules stand now, it looks like the 2020 percentage standards effectively claw back some of the lost mandates from 2017 through 2019 due to 2016 through 2018 due to the application of the SREs. So there's already been a request coming out of the refining industry to revisit the 2020 standards in light of this ruling. It will be very interesting to see how the EPA handles it. Their previous position had been that once a final rulemaking has been released, that is pretty much sacrosanct, and once the compliance year is started, you can't go back and change things. We'll see if the EPA chooses to reverse that stance. And on top of that, the latest information looks like the refining industry may well appeal the 10th Circuit decision all the way to the U.S. Supreme Court if the Supreme Court will take it as a case. So lots going on legally and regulatory wise as a result of the 10th Circuit decision on small refinery exemptions. And then on top of that, we have a set of petitions in since the pandemic has started from states and municipalities even for a waiver of the 2020 standards based on the argument that the standards are causing severe economic harm to states, municipalities, and even the entire United States. This is a well understood, well known waiver provision in the RFS statutes, not like the SREs, which some of that appears to have been literally invented by the EPA in recent years. There is clearly a provision in the RFS statutes when it can be shown that the mandates themselves are causing severe economic harm, that there's a safety valve provision to have a waiver of those standards. Of course, the argument will be, can it be shown that the 2020 standards are causing severe economic harm? It's important to note that we've had previous general waiver requests on similar grounds in 2008 and 2012, and they were soundly rejected by the EPA, largely based on the argument that to demonstrate severe economic harm, you have to demonstrate that the standards themselves are the source of the economic harm. And so based on that standard, it's clear that the refining industry in the US has faced severe economic harm, but it's been due to the COVID pandemic rather than the RFS standards. But we'll see. But that's hanging out there. And those waiver request petitions have been made to the EPA, and the EPA will have to rule on them. So it's something certainly keep an eye on. Lastly, in the HEROES Act, just passed by the U.S. House of Representatives, that legislation, again, only passed by the U.S. House, authorizes the USDA to provide 45 cents per gallon of ethanol produced from January 1st through May 1st, 2020, to provide some relief for the U.S. ethanol industry. My own personal view is that that's unlikely to make it through the Senate and be ultimately passed into law, but it does provide a first toehold for providing some relief for the U.S. ethanol industry directly from the U.S. government. So I think we'll see more about this, and ultimately, will there be some relief provided to the ethanol industry? My own personal view is probably yes, but maybe not this much relief is implied in the HEROES Act. So that's my review of the policy issues that are at play, and I'll turn it back to you, Todd.
Thank you. Yes, indeed. Thank you very much. Let's take this poll. Again, there are about 100 more of you here than there were the first time around. So the poll asks, in your local area for the remainder of 2020, how much do you expect people to drive? And the answers can be about normal, slightly below normal, which is around 90% of normal, moderately below normal, about 80% of normal, and then a couple of other things well below normal, between 25 and 70%, and the roads are likely to be empty, less than 25%. Go ahead and answer that question. About 70% of you answered it the first time around. We're approaching that at this point. If you go ahead and continue to vote, I think we'll get there, or get within 10 percentage points of that, which I suppose is large spread, but we'll see how that goes. Looks like we're almost there. Why don't we go ahead and close this one out? And here we are. So now that number slightly below normal at 35% has increased pretty dramatically, I think, because it was moderately below normal and well below normal, which were roughly the 42 and 35 before, or something along those lines. So there is a change in this particular poll. You wanted to say something, Scott? Yes? No. Anyway, let's continue on. I want to tell you about those people that are sponsoring our webinar for the day. They include the TIAA Center for Farmland Research. That's at farmland.illinois.edu. It's right here on the Urbana campus. In fact, in Mumford Hall, where most of us are based, and Compeer Financial is helping us out, along with Farm Credit Illinois, Growmark, the Illinois Corn Growers Association, and the Department of Agricultural and Consumer Economics and the College of Agricultural and Consumer Science, Environmental Sciences. I do want to talk just a little bit with Eric Moseby from Palestine for just a moment, because he's been with us as well. Good morning to you, Eric. Thanks for being with us this whole time. I appreciate you being here. Can you tell me how Lincolnland Agri-Energy has been doing through the pandemic?
Yeah, thanks for including me. You guys covered a lot of stuff, and we focus a lot on those weekly production and stocks reports as an indication of where the market's headed and what the industry is doing. So I think it's going to be really interesting to watch how the ethanol industry responds throughout this recovery. Will we come right back on and blow right through those old production numbers and increase stocks again, only to crash the margin? Or will we take a more measured approach and a more disciplined approach? And I'm hoping for the latter. So here at Lincolnland, we have been operating at a reduced rate since March. You could start to see this happening, and then looking at our production planning and nominations from our fuel customers for April, and you could just see how the demand destruction was going to be very, very very, very imminent. And so we slowed. That's how we cope with things. We slow down. We try to match our production to demand, and cut costs as much as we possibly can, and then see how that plays out. And of course, things change, and literally things just changed almost weekly throughout the last part of March through April, and now starting to feel, as you guys mentioned, a little more stable as we start to see demand come back, and customers starting to talk about what their needs are going to be for next month. So May, there might be a little bit of lag in what plants are producing, and May looks like it'll be the low water mark for production for us, and then we'll come back in June and hopefully the summer as we start to see hopefully driving demand increase. And I guess I was glad to see the poll change a little bit and the data get a little bit better towards the end, that maybe we'll get back to more closer to a normal situation this summer. And then who knows after that, right? Whatever happens in the fall, schools opening, a lot of challenges with businesses trying to open up, and then who knows where we go from there. So Lincolnland's coped fairly well. We were able to slow down. Yes, it's always an initial shock to the econ of a plant when your prices are in free fall, especially if you have inventories on the books. But then there's always another side to that when the recovery comes. So try to look further out than just what the next few weeks are going to be, and try to look at things at least quarterly. And usually if you look at things quarterly, there's a little bit of light at the end of the tunnel.
You mentioned that May will be the low water mark for production. Is that because inventories on hand will be being used during that time, both for gasoline stocks and ethanol stocks, or for some other reason?
Well, I just see customers starting to increase their orders just a little bit more, just coming back on. Maybe they move through some of those inventories that they had after that initial fall. I think every situation is a little bit different depending on the geography you're in and the market you're serving in that respect.
you've got questions for Todd Hubbs or Scott Irwin or Eric Moseby, go ahead and put those in the question box. We'll get to them here pretty shortly. I've got a couple of other questions for you, Eric. Today, apparently, the lobbyists for the ethanol industry are descending. I've read a couple of things that say swarming across Washington, D.C. Are you privy to what they're hoping to gain beyond what was in the HEROES Act, and does that actually work for you?
Well, I guess it was good to see something for ethanol in one of these bills. I mean, ethanol has largely been left out of the free money parade that goes on in Washington. So it was good to see that we got recognized. I'm not exactly sure what points they're pushing today. I know there are a lot of issues. We've been winning in the courts. We've been winning the court battles, as Scott mentioned. Good to see some money out there for infrastructure for higher level blends. And, I think that'll be a slow, long road, but I do think we'll see growth there. So we've got to keep going on that path and try to offset some of these export losses that we've seen in the past and other demand losses. But those charts were very telling. I mean, you can look back to even go back into 2018, throughout most of 2019, the industry was already struggling and just continued to keep production high as we saw demand start to falter. And obviously you can't do that forever, or you'll see a significant problem with your margin. And I was surprised. I didn't realize in looking at the chart on the margins that there's a fair amount of time spent below the break-even line when you're in the ethanol industry. And so that's why I try to make the point about a disciplined stance on production and really take market cues.
So the market cues is a question that we do have from one of our listeners, viewers, and one that I had as well. They want to know, how do your customers break down blenders, livestock producers, and CO2 buyers? And can you adjust? For instance, I would think that the latter two probably I know they've had a difficult problem finding the Ddgs and the CO2.
Mm-hmm. Well, so there was a chart there that talked about the initial short covering on Ddgs. It takes time for the livestock industry and any industry to adjust to something that happens this quickly. So yes, there was an initial spike, and that really made decisions not easy, but made decisions easier here initially, that we would just continue to run. We saw the DDG strengthening. We'd be able to help supply those markets. But when you're running an ethanol plant, you still have the same amount of ethanol, you still have the same amount of DDGs, from a fractional standpoint. So you can't really adjust to make one more or another more. All the products have to go together, and that's how you view your margin. So you just have to watch all of the products in the equation there to make the decisions.
Hey, Eric Brown, I accidentally deleted your question. If you could put that back up for me, I would appreciate it. Here's a good question. Do you see consolidations, the futures, as the future for ethanol producers? Now, you're an independent, so I'm wondering what you think about the rest of the industry.
I guess my opinion, this is just my opinion. Yeah, I think consolidation is inevitable long term. Yes, this industry has a lot of independent, well-run, well-managed plants that are owned by the ag communities, co-ops, that sort of thing, and those are great circumstances. But it's just the history of industry as we go through these cycles of ups and downs. And ethanol industry has been, a relatively volatile industry, right? So you have a lot of independents, a lot of fractional pieces and parts out here all doing their own thing. I think it tends to create more volatility, tends to create those ups and downs that will eventually push plants to consolidate with one another. And this will take a while, right? It'll take years to do that as different circumstances change. But I don't think we can say that that's not on the horizon. I think it is.
What difference does the production of hand sanitizer make to the industry, if any?
Well, I've seen it described as a Band-Aid, or just something that can keep you going. It might even be more than that if we could ramp up. I know right now many plants are waiting on a more clarification from the FDA on what we're allowed to produce and what we're not allowed to produce. So it's a good thing. It shows that our product is very useful. The ethanol molecule has a very important place in the marketplace. I'm glad that plants are able to produce that sanitizer.
Todd,
DGGs? Yeah, go ahead.
Scott, I have a question for Eric. What kind of changes to your plant operation have you seen, and do you foresee, just to deal internally with COVID?
Well, the normal, personnel issues are something that's at the forefront of any business that's trying to operate right now. So you do the normal distancing and precautionary policies, and the other thing is it delayed. I guess one thing is it did delay some work. You don't bring as many contractors in. You maybe delay some maintenance work. Is that a problem or is it not a problem? Time will tell. I think if it's managed well, it should not be an issue. You'll be able to delay some things and maybe perform them at a later time. But nevertheless, it definitely changes the way you operate here in the near term.
Hey, Scott, I think this question is for you. Is this shock a preview of future ethanol demand destruction from CAFE improvements, electric vehicles, and such?
Well, this is a question of both that Todd and I have thought a lot about, and I certainly invite him to jump in on this as well. I want to represent our views correctly. I don't know that I would say that this shock is representative of what we'll see in the future, because this is just a dramatic, halving of production, and it's going to be over a very short period of time, presumably a year or so, maybe 2 years at the most, who knows. But we definitely see a future where the U.S. is going to transition to primarily electric vehicles in surface transportation. That the real question is the time span that's going to take. There's a wide range of views about the adoption of electric vehicles. I think I would say, Todd and I lean towards probably faster than conventional wisdom might suggest. And with that, I'll let Todd jump in and add whatever he wants to that.
Yeah, the infrastructure for electric vehicles needs to be more robust than it currently is. And we're still not to where we would see, a break-even price per se between an electric vehicle and an internal combustion engine vehicle. This may accelerate this kind of process, not that, because of anything to do with ethanol per se, but what we'll see with oil production down the line, we'll see oil prices increase over the next couple of years under this new dynamic. I think you'll see electric vehicle adoption pick up with a good pace in the early 2020s. You may think of 2022, 2023 as an inflection point for this kind of adoption rate. We still will have a lot of fleet vehicles out there, so the impact on gas demand will be, I think, consistent and pernicious through 2040, basically. So we could get to a place in 2035, 2040 where we may see gas demand down significantly, which takes a lot of ethanol and corn use for ethanol out of the equation. That's 20 years down the road. I cannot see a scenario where this doesn't happen. And I agree with Scott. It's just the question of how fast. and these kind of technological adoptions can really take off. And so I expect personally to see this start in the early 2020s, 2021, 2022. You'll start seeing more and more of the new fleet be electric. We see a lot of car companies investing in this technology. The money's been put in, and I think the cards have been dealt. So it's not going to be a immediate shock like we saw with COVID-19. I think it's more of a gradual grind downward that lasts multiple decades.
Eric, is there any reason to believe that there will be space in the electric vehicle area, I'm sorry, for cogeneration of power, whether that's, a hybrid vehicle that's ethanol electricity as opposed to gasoline electricity, and or cogeneration of other types of energy?
Hey, the first one really I've heard talk about, or I've even read about, ethanol electric hybrid. I mean, that's a nice path forward for an ethanol plant or for agriculture, really, because I agree with what Todd said. I mean, growth for the ethanol industry is going to be, it's not impossible, but I would say it looks like it will be challenging if we don't have significant exports pick up and we don't see a way to get ethanol into other countries and start to put it in their gasoline supplies, because it does seem like the writing might be on the wall for electric cars, and yeah, over time, right? It's going to take time. So again, I think it goes back to production discipline, how we manage these plants going forward. What options can we come up with to make them profitable with other products and product diversification, and continue to utilize the U.S. corn crop.
Todd, I wanted to jump in on that, if I might. There is a place for biofuels and ethanol in that long run future, even with electric vehicles, but it may necessitate a change in focus for the industry and our policy away from what we call the surface transportation fleet towards the jet fuel and the maritime markets. There's, like the way I like to put it, until we can get the Star Trek dilithium crystals, there's nothing on the horizon that indicates that airplanes are going to need anything other than a liquid fuel to burn. Same thing for maritime transportation. These are major energy sectors, and I think in the long run, as we're looking into the 2030s and 2040s, that's where we need to shift our focus to for opportunities for biofuels and ethanol.
I think this question will be for the ag economist, but Eric, if you want to answer, that's great. They want to know what the risk is of ethanol imports from Brazil. I think given the real, the glut of ethanol in Brazil, a couple of other things at this point as well.
I'll leave that to the economist, I guess. I mean, I think,
you tried, Todd.
Yeah, they tried to be silent.
So they've got a currency issue, right? So I think as long as that is going on, the competition is going to be pretty steep from them. But go ahead.
Yeah, I jump in on that. That's actually, it's now just a sidebar. It would have been a much more interesting story pre-COVID, is the influence at the margin of the California low carbon fuel standard on the ethanol market. What we saw in 2019 is actually a noticeable tick upwards in the aggregate ethanol blending rate. You can't really see it from the chart that I showed in my presentation, but it's there. And it's pretty clear that that's related to Brazilian ethanol, which gets a low carbon score, coming into California and they're using it, as best I can tell, in increased quantities of E85 at the pump. Because if you look at the EIA's data on E85, as imperfect as it is, it showed a pretty nice jump in 2019. So that could certainly happen. I don't know if there's any emergency changes in the LCFS regulations being considered in California, but we're likely to continue to see, I think, increased imports of Brazilian ethanol into that California low carbon fuel market, as long as the carbon ratings that they use for the different fuels are kept in the current range. So again, the quantities relative to the overall size of the U.S. domestic market are still not that big. We're talking a few 100 million gallons, but at the margin, it of course does have an impact. But I think it's a really interesting question.
Is there any reason to believe that co-products like the DDGs, this person asked, will be traded in a index-related pricing rather than a flat price because of the recent volatility?
I suppose he means like maybe index to soybean meal or something similar. I think in some markets they are, but all ethanol plants are the same, but they're all different because of their geography. And I still think the localized markets and the regional markets will probably dictate pricing more so than some kind of a widespread index. But I don't know if that answers the question or not.
Here's a question, and I think the ag economist may take a stab at this. Earlier this year, the Guardian Energy Management CEO estimated between 15 and 60%, 15 and 60% reduction across the ethanol industry. Explain the difference between that and the USDA forecast of 4 to 5% decline.
Todd, I'll let you jump in on that.
No, I sort of talked. Yeah, I'll try to jump in on that. Eric didn't discuss this, but I think he hinted at it. There's a lot of capacity. There was a lot of capacity in the ethanol industry. I think I'm not going to put words in Eric's mouth or the ethanol industry's mouth, but the hopes for higher blend fuels haven't really panned out the way a lot of people thought. There was also a lot of hope for stronger exports that haven't materialized. And I think I'm not familiar with the Guardian Energy study, so this is just me speculating on what the question means. But you could see fewer ethanol plants or consolidation, as Eric said, over time. And it wouldn't really impact the kind of forecast the USDA is putting out for corn use and ethanol. I think in the long run, you're going to see this consolidation. Who survives this shock? Who's coming back and who's not? We could still easily do 5.2 billion bushels of corn use for ethanol with some of the plants leaving, in my opinion. And so I think maybe that's what Guardian was hinting at. The idea that we're going to see it at 15 to 60% drop in ethanol use next year, or from the industry as a whole, over 2021 marketing year, seems extreme. That would imply that the resurgence in the COVID-19 cases in the fall are very, very severe. Another round of lockdowns, which I don't see that happening right now. We could see it, and the uncertainty is huge, but I'm not sure that's what they were talking about. I think it's more of an industry shakeout. Scott, do you have anything on that?
No, I agree. That would be a pretty dire scenario with respect to COVID. And you did see in the earliest, in that early, what I call downdraft stage of the pandemic and the restrictions, some very negative, bearish long run forecasts on gasoline use and therefore ethanol use as we dealt with the pandemic. And I never bought into those. And I think that the V-shaped recovery that we're currently seeing in gasoline use has showed that those were too negative of expectations. And if anything, my bias is towards that even my earlier quote unquote optimistic expectations for the rate of recovery in gasoline use and ethanol use may have been a little conservative.
On that note, we've reached the top of the hour. Thank you, everybody, for joining us and staying with us for the full hour today. Our panelists, of course, we'd like to thank. They include Todd Hubbs, agricultural economist, Scott Irwin, also an agricultural economist, both here on the campus of the University of Illinois, and Eric Moseby, who is a general manager at Lincolnland Agri-Energy. It's an ethanol production plant located in Palestine, Illinois. I'm Ben, your moderator for the day, farm broadcaster from University of Illinois Extension, Todd Gleason, and Jim Baltz has been behind the wheel, the technical director for the day. Thanks to him, too. You have a good day. Remember that we'll have an upcoming webinar, the last one in our series, at least at this point. That is on Friday of this week, and we'll take up the pork industry, some perspectives from the Mashoff side. The Mashoffs, of course, are located right here in the great state of Illinois. And we'll talk to them on Friday at 11 o'clock. We hope that you will join us for that webinar as well. You have a great afternoon.